This is our second lesson of accounting, and in this lesson we will discuss about transaction analysis. So first of all, I will explain to you business transactions and then I will show you how to record the transactions. So what is a transaction or what is a business transaction? Business transaction is an exchange of things of value. So easy, exchange of things of value. If you will see in our daily life, when you go to a shopping, when you buy anything, these are also called the transactions, because sometimes we pay cash and instead of paying cash we receive something, we purchase something. Suppose if we are going to buy some supplies, so we are paying cash. Sometimes we use the credit card, sometimes we use cash, right, debit card, and we are receiving supplies, right? So exchange of things of value. So here I have explained the transaction in a more meaningful manner, that something of value is given and something of value is received. This is called the transaction. Suppose if we buy supplies, right? So what we are paying, what we are given, cash, if we are using cash. So it is a valuable thing. Cash is the valuable thing. So something of value is given, and instead of this cash, we are receiving supplies. Something of value is received. This is called the transaction, right? Simply you can say exchange of things of value, or you can say that something of value is given and something of value is received, is called the transaction. So see here I have mentioned a transaction is an event occurring in the operation of a business that results in the financial change, right? Financial change means, suppose we have $100, and if we are buying the supplies of only $10, so we are reducing our cash. At the end we have now $90 left. So is a business transaction that results in a financial change. A business transaction always include an exchange of things of value, right? So now you know very well about the business transaction or a transaction that exchange of things of value. So here is the balance sheet, right? In the first lesson we have discussed this balance sheet in detail, but again I will explain to you quickly that at the top of any statement, not in balance sheet, if you are making the trial balance, if you are making income statement, cash flow statement, balance sheet, you have to write down three W's. This is called three W's at the top of the statement. The first one is who, means name of the business or name of the person. So in this case our company is Robert Inc. So you can write down Robert Inc. And then what, second W is for what is this, what you are making, balance sheet, income statement, trial balance. Then you have to mention in the second line in the center of the statement. And third is when you are making, we are making March 31st 2017. Again I will tell you one more time that these should be in sequence. First should be the company name. You cannot write down the date at the top and then or balance sheet at the top. First the business name, then statement name, and then date. This is called the three W's. So in the case of balance sheet, these are the assets. In assets we have cash, accounts receivable, supplies. These are called the accounts: cash account, account receivables account, supplies account, land account, and so on. And how we have to arrange these accounts according to liquidity. Liquidity means the items or accounts which you can convert easily into cash. So always keep in mind at the top, always you have to write down cash, and then account receivable, and then supplies, right? But there are more accounts as well. As we will move to the third or fourth lecture, I will introduce more accounts, because this is the very simple balance sheet. That is why here we have used only few accounts. So supplies, if you need cash, you can convert your supplies easily into cash. But if you have a land, building and equipment and you need cash, you can convert but not easily these items. That is why you have to write down all the accounts according to the liquidity position. These are called the current assets. These are called the fixed assets. Again, we will discuss this in detail in the next lesson. Here you have to write down the liabilities. Again, if the liability is payable within 30 days, you have to write down at the top. And then loan mortgage is usually for 20 years or 30 years. That is why again you have to write down in a sequence. Total liabilities and owner's equity. This is called the balance sheet. In balance sheet equation is assets is equal to liabilities plus owner's equity or capital. So always keep in mind that assets should be equal to the sum of liabilities and owner's equity. In this case, we have 80,000 of assets and 80,000 of liabilities and owner's equity. Here I have written some information about the balance sheet and accounting period. That balance sheet provides a thorough or a complete picture of the financial position on a specific date. This is important point in case of balance sheet, that balance sheet gives the thorough information or complete picture. When you will see this balance sheet, you will find out that how much cash you have in your business, how much accounts receivable. Account receivable means you have provided services or sold something on credit, so you have to receive these amount from customers, various customers, and then supplies, so it will give you the financial position on. We make the balance sheet on a specific date. So assets is equal to liabilities and owner's equity. This is very important. This is called the balance sheet equation or the accounting equation. Now is the accounting period. Accounting period is the span of time covered by a set of financial statements. This time varies from monthly to yearly depending on the factors or the size of your organization. Sometimes we make the balance sheet, right? But usually we make the balance sheet on a specific date, monthly. But other things, income statement, we can make yearly, right? Trial balance and other statements. So the topic is actually transaction analysis, and we have discussed what is the meaning of transaction. Now we are considering the transaction. Whenever you will see any transaction in a business, I told you that in daily life we also do the transaction. Suppose if you will go to the grocery store and buy groceries, this is also called the transaction. But this transaction should be separate from your business. Your personal transactions should be separate from your business transactions, right? Here we are discussing the business transaction, so I will show you how to record the transaction. So always, whenever you see the transaction, always you have to ask four questions, or you can see you should consider four questions. The first one is, which accounts change in value as a result of the transaction? This is the first important thing. Which accounts means, see, these are the accounts: cash, receivable, supplies, accounts payable. These are the accounts. Whenever you will see any transaction, you have to find out which accounts will change. Second is, how much do the account change? Third is, do the accounts increase or decrease in value? After considering this, then we have to record, and then we have to find out whether the equation means balance sheet equation, is balanced after the transaction is recorded. And always keep in mind, whenever we will record the transaction, your asset should be equal to liabilities plus capital. So these are the four questions. The first question is, which accounts change in value as a result of transaction? How much do the account change? Whether these accounts increases or decreases? And the fourth is whether your balance sheet is balanced or not. So these are the few transactions. The first one is purchase supplies for 500 cash, receive 3,000 cash from customers. So one by one we will discuss these transactions, right? This is the first transaction. Purchase supplies for 500 cash. I told you, whenever you will see the transaction, you have to consider these 4 points. So, right? So, first of all, again, we will start purchase supplies for $500 cash. So, the first point is which accounts change in value as a result of the transaction. And one more thing, that each transaction, these are the transactions, each transaction affects at least two accounts. Now, what does it mean? See, we have different accounts, and again, these are the few accounts, right? A cash, receivable, supplies. Each transaction affects at least two accounts, any two accounts, maybe cash or owner's equity, maybe supplies or accounts payable, any two account at least. You cannot have that transaction is affecting only one account, equipment. No, each transaction affects at least two accounts, right? There may be more than two accounts, but at least two account is compulsory. So see, purchase supplies for $500 cash. First of all, you have to find out the two accounts. So first account is supplies, because we are purchasing supplies, and then another is cash, right? So second question is, how much do the account change? How much? This one. Do the account change? So is a $500. Third is whether the accounts is increasing or decreasing, right? These two accounts. So we are purchasing supplies. It means our supplies are increasing. So here I will use the positive sign. It means increasing, and negative means decreasing. So this account is increasing, and cash, we are paying cash. So our cash is decreasing. Suppose if you have a $1,000 and you are buying the supplies of 500, so now you have 500 cash remaining. So cash is decreasing and your supplies are increasing. The fourth point is whether your balance sheet is balanced or not. So I will show you how to record it. This is called the transaction analysis sheet. In the practical life, you do not have to use it, but here I am explaining to you. In this way you will learn more, right? So these are the opening balances of cash 10,000, account receivable 12,000, supplies 4,000. From where I have written these opening balances, I will show you from here. This is the balance sheet March 31st, 2017. These are the opening balances. After entering these transactions, we have to make the balance sheet again on April 30th, because these are belong to April 3rd, April's transactions. Then our account will change. So see here, this is April 1st. Our first transaction is on April 1st. What I said? Supplies. Supplies are increasing by 500 and cash is decreasing by 500. So what I told you, then you have to make a balance. That whether your fourth point is whether your statement accounting equation is balanced or not. So see, 10,000 minus 500, now we have 9,500 remaining in cash account, right? 12,000 we have in account receivable, because this transaction does not affect on account receivable. Supplies now we have for 4,500. Land we have for 15,000. No effect with land, right? And I will write down just this one. It means these are same. These are same because this transaction does not affect any of these accounts. So these are okay. So when you will count left hand side and right hand side, it should be balanced. See, 6,000, 10,000, 19,000 plus 45,000, 80,000. This is also 80,000. Second transaction is on April 12th. And what is the transaction? Received 3,000 cash from customers who owed money. What I told you, 4 points. These 4 points you have to discuss, right? First is which two account each transaction affects at least two accounts. So first of all, you have to find out the accounts. Received cash. You are receiving cash. So first account is cash. What is the other account? From customers who owed money. The second account is accounts receivable. Why? Because now you have performed services on account to different customers. Suppose ABC. Now you are receiving that amount. So when you receive cash, your cash will increase. An account receivable was 12,000. You are receiving 3,000. So it is decreasing because at the end now you have only 9,000 left. Right? So how I will record this transaction? Cash. We are receiving 3,000 cash, and this is the account receivable. Total account receivable was 12,000. Account receivable means we perform services. The business owner performed the services on credit. Now he is receiving the amount 3,000. So account receivable is decreasing. And nothing affect to these accounts. So again make the balance. So it will be how much? 12,500, and your account receivable is 9,000, right? And these will remain the same. 4,500, these will remain the same. Again you have to make a balance, so it should be equal. Now is on 13th. What happened on 13th? Bought new equipment 4,000, the value is 4,000 on credit from Ashing. First of all, you have to find out what accounts. Bought new equipment. You are buying new equipment. First account is this one. The business owner, Robert, is buying a new equipment for 4,000, right? Now how he is paying? He is paying cash or credit card? Credit. Right? Credit. It means this is the liability, accounts payable. The second account is accounts payable. So these two accounts are affecting. Bought new equipment for 4,000 on credit. Whenever you will see on credit, it means payable. This is the liability. This is the first point. Second point is for how much it is increasing or decreasing? 4,000. Third point is whether these two accounts, equipment and payable, increasing or decreasing. Bought new equipment, right? He is buying new equipment. It means equipment is increasing. And liability, what about liabilities? Increase or decrease? Increase. Liability is also increasing, right? Okay, how you will write down this transaction now on 13th? This is, it will remains the same all. Now this is the equipment. He is 4,000 is the value of the equipment, and then payable. This liability is again increasing. Before he has to pay 6,000, now 4,000 more, so 10,000, and all will remain the same, right? And then here you have to write down the balance. This is 12,500, right? Account receivable is 9,000. Similarly, supplies 45,000. This, and equipment is now for 23,000. Initially, it was 19,000. He has purchased more 4,000 more, and liability is here 10,000, and these are same. Now is the fourth one. Robert, owner, invested 3,000 cash in the business. He invested more. So cash is increasing and owner's equity is increasing. So here we will write down what is the date is 24th. On 24th, he is adding 3,000 in the cash and 3,000 in here. It will be 48,000 now. Before the owner's equity was 45,000, he invested 3,000 more. So is now, and these account will remains the same. But here in balance we have 15,500 cash. And the last transaction is purchase equipment. See, this is very important. I told you that each transaction affects at least two accounts. In these four, each transaction was affecting two accounts, but in fifth one, this transaction will affect three accounts. Purchase equipment from Raj Inc. at a cost of 4,000. See, one account is equipment. Now, how is paying? He paid 2,000 cash, remaining will be paid in 30 days. See, he didn't mention the amount, how much the remaining. You know that our total amount is 4,000. 2,000 he is paying cash, so remaining is also 2,000. And within 30 days, it means short term liability and accounts payable. So, how we will record it here? In here, he is paying cash 2,000. Equipment is now for 4,000 more, and liability 2000 is increasing. When you will balance your assets, it should be equal to 89,000, and on liabilities and capital or owner's equity should be 89,000 for these transactions. So we have discussed these transactions one by one, and each transaction we discussed these 4 points. Then we made this transaction analysis sheet, but here I have made for you neatly this is called the transaction analysis sheet. This is the same thing whatever we have discussed. Assets is equal to liabilities and owner's equity. These were the opening balances. See, 500 supplies here is increasing, then is balance, right? Here I have just like them put this sign here, but in practice you have to write down complete figures. In this way you will learn more. After entering each transaction, you have to make balance and see your assets should be equal to liabilities plus capital, and at the end is 89,000, 41,000 payable, liabilities 48,000, owner's equity. When you add these two, it should be 89,000, 89,000. Right? Okay. Now here again, you have to make the balance sheet with the new balances. Before we had cash 10,000. After entering the transactions, cash we have 13,500. Account receivable is 9,000. Before it was 12,000 because we have received 3,000 from the customers. Supplies 4,500. Initially we had 4,000. Equipment was 19,000. Now we have 27,000. Similarly, you can change the here. It was 45,000, now we have 48,000. Liability was 6,000, now we have 12,000. So this is the new balance sheet at the end of the month, which will give us a thorough picture information about the assets, liabilities and owners equity. Here I have written some accounting terms. In each lesson we will discuss some accounting term. So what is the entrepreneur means? A person who organizes and operates a business. Suppose you have a business, you are operating a business, you are organizing your business, you are the entrepreneur. What is the purpose of accounting? To provide financial information for decision making. See, on the basis of balance sheet, on the basis of income statement, we make decision. That is why these statements are important, or accounting is important. What is capital? Owner's net worth found in owner's equity section of the balance sheet. See, assets is equal to liabilities plus capital. Liabilities is, you can say, the loan, but capital, how much is the owner's worth, is called the capital. Creditor, business or a person that has extended credit or loan money. Debtor, business or a person that owes a business money as a result of purchasing goods or services. Liquidity, the order in which assets would likely to be converted into cash. I told you always you have to write down cash, then marketable securities, then receivable and so on. Maturity date, liabilities are listed on the balance sheet according to payment due date from most recent to the longest. Right? Accounts payable, current liabilities usually within 30 days. So you have to write down, and then bank loan and then mortgage payable and so on. So these are the few terms. Then I have set a practice problem for you. These are few transactions which we have discussed. Purchase supplies for 1,000 on credit. So again you have to read this transaction. You have to discuss 4 points. First of all, which two accounts are affecting, whether these accounts are increasing or decreasing, how much, and whether your balance sheet is equal or not. You have to read one by one. And this is the transaction analysis sheet I have made. These are the opening balances. After recording all these transactions, you have to make your balance. Assets should be equal to liabilities and owner's equity. Then you can make your balance sheet and you can see the financial position of the company. So we have discussed transaction analysis. I hope everything is clear, but it's still, if you have any question, without hesitation, you can write down in comment section. Please do not forget to subscribe to my channel on YouTube, Saima Academy, and thanks for watching.